Welcome back, everybody, to Volatility Trading Strategies. So I have no doubt that all of you out there who are interested in volatility trading, you will eventually get to a point where you understand how the volatility ETPs work and how to make a profit trading them. Now, spoiler alert, that will probably end up being on the short volatility side of things. That's where you're going to end up. But for whatever reason, especially early on in people's journey, it's that long volatility side of the equation that is the most tempting for people. And unfortunately, many traders out there lose significant amounts of capital before they learn this valuable lesson. So this is going to be part 1 of what will likely be a 3 or 4-part series breaking down all the reasons why you probably shouldn't be trading on the long volatility side of things. So as always, subscribe to the channel, give the video a like for me, it really does help with the algorithm, and let me get into all the reasons why you shouldn't buy the VXX. So to set the stage on this multi-part video series, I do want to make clear right from the start that I completely understand why so many people are tempted to buy those volatility ETPs. Whenever we feel like the equity markets are maybe a little bit overvalued, maybe due for a correction, our mind goes straight to that VXX, the UVXY. We think, well, let's just buy those, and when the market crashes, we're going to make a bunch of money. That's what we think. Now, of course, there's many problems with that, and that's what I'm going to go over in detail in this series. But I understand where it's coming from because I also have experience doing the same thing. I tweeted about this recently because I'm so fed up with people insulting newer traders who are still tempted to buy VXX or UVXY. I'll just leave this multi-part tweet storm on the screen for you if you want to pause and read it, but the thing that applies most for today, everyone is at a different stage in their learning curve. All of us at some point thought long VXX was a good idea. If you say you didn't, you're a liar. Just because my long vol phase was in 2010 doesn't give me the right to insult others who haven't yet learned the lesson. So that's a great place to start. I want to actually show you that I've done this as well, and I completely understand the temptation of trying to time those volatility spikes. All right, really quickly here, I'm just going to go over some of my initial trades with VXX way back when. So for that, I can go to my account, go to transactions. For this, we can just put in VXX, and then for me, that's going to go all the way back to 2010. So I started my investing career as a derivatives trader in 2005, which pretty much means I was trading volatility right from the start. So when VXX launched in 2009, I was aware of it right away. But of course the volume was incredibly small and it just wasn't tradable early on. So I gave it about a year and then I went back and I started trying to find some strategies to make money off this thing. And we can go through some of those initial trades here. So I started off, you can see, in July of 2010, and right out of the gates I'm buying 1,000 shares of VXX. A couple days later, looks like I bought some more, sold a put against them to generate some premium, bought some more, so I'm doing the whole average down thing as I'm realizing this thing is decaying on me. August 10th, bought another series of long shares. So at this point, I'm a good 110,000 in on this long VXX thing. Now let's see if I actually knew what I was doing. Was there a reason with the VIX futures term structure that made me think long vol was the way to go at that time? So July 27th, 2010, we can go over to the VIX term structure. I'm just going to go to historical prices here, and we're going to go back to 2010, July 27th. We're just going to see if I knew what I was doing. Now, in part 2 of this video series, I am going to break down what this curve means and when it's most advantageous to be long or short volatility. But for this video, let's just say that an upward sloping VIX futures term structure that is heavily in contango, with a lot of roll yield here, this is pretty much a terrible time to be long volatility. And yet in my account, that's exactly what I was. I had allocated a pretty decent amount of money to being long volatility. Now, obviously at the time, I must have done this because I thought the markets were going to crash. And in fairness, this is July 2010. We had just come off the flash crash. Financial crisis just ended the year previous. Most people weren't trading back then, but I can tell you as somebody who was trading through the financial crisis and then the following years, we were pretty much on a hair trigger thinking that it was going to be a double dip and we were going to see the markets crash again. But anyway, as I showed you, there's no reason logically or mathematically why I would be long volatility. Side note, don't you just love the targeted marketing on VIX Central? I just bought a pair of shoes yesterday online, and now everything I open, all of the web pages are like, hey, maybe you want this pair of shoes. Can I interest you in this pair? No thanks, I got the ones I wanted. Hey, maybe you want these ones, they're 42% off. Anyway, back to the VXX. I went through a period where I was obviously long for the wrong reasons, and then I did a whole bunch of option trading, you can see here, just bouncing around strategies, testing things out. There's a lot of activity here going on, trying to figure out this product. But what I want to show you is, if I go down to here, you can see this one in November 2010. This is the first time that I actually went directly short. A lot of the option trades above here are short strategies, but it did take me a few months to realize that going long when the term structure is not advantageous is a low probability trade. So let's just check out November 10th, 2010 and see what that date looks like. So we'll go to November 10th. And there we go. Now it's upward sloping. This would be a time when, if this was the only input variable I was looking at, I would say that short volatility here does make some sense. So it took me a few months to finally get around to that idea, but late 2010-ish, I was done with my long volatility phase, and the 11 years since then, I've just trained myself to find much more efficient ways to play a market that could potentially be overvalued. Buying VXX because I think the markets are going to crash, I learned a long time ago that is a really low probability trade. So clearly I've been there as well. When I first started trading VXX back in 2010, I also thought that I could successfully time those volatility spikes. But the truth is, and that's the topic of this first video, is that it's just a very low probability trade, and you will spend most of the time just bleeding capital. So this here is the VXX over just the last 1 year. And you can see it's actually still up a little bit of money. It started back here below 16, and right now it's sitting at 1682. So buy and hold, it's actually up a little bit. But of course, in fairness, it has been an exceptional year. But even if we go back 2 years, the chart doesn't actually look that terrible. Now, it's way down in value. You can see 2 years ago it was at 50, and now it's at 1682. That's a huge loss. But some people might still look at this and say, well, there's 2 big downdrafts, that's true, but there's that one big spike, and maybe they would have been able to catch that one. Or maybe they look at some of these other smaller spikes along the way. There's been a few this year as well. Maybe they think they can catch those. Sometimes I think this is why people think they can profit from going long vol. Maybe they're just not starting with a realistic picture of what the actual long-term performance looks like. This is the VXX, which is just an unleveraged 1x long volatility ETP that launched on January 29th, 2009. This is the original volatility ETP that started it all. Now, I'm showing the splits here because it has done 5 reverse splits since inception to keep that price from bleeding down to zero, because that's exactly where it goes. But on a split-adjusted basis, it launched at a price of over $102,000. And as of making this video now, it is below $17, down 99.9% since inception. And when we back up like this and look at it over the entire history, not just 1 or 2 years, the probability of timing one of those tiny little spikes doesn't seem very promising, does it? When something is down 99.9%, it's pretty hard to make money on the long side. And if we use simulated VXX prices going back to the launch of VIX futures in March 2004, we can see the VXX would have gone from about $400,000 down to below $17. The financial crisis did slow things down a little bit, but that's just a blip on the long-term trajectory of this long volatility VXX. Or maybe you like the additional leverage of UVXY. Remember, this one is now a 1.5 times leveraged long volatility ETP, which launched in October 2011. Again, lots of reverse splits here to avoid going to zero, but split adjusted, the UVXY, when we're calculating for a 1.5 times leverage factor all the way back to October 2011, has gone from 1.7 million to below $11. That's as close to a 100% loss as you can ever imagine. Why would anybody look at something that is down basically 100% and think, no, I'm really good at timing things, I can still make money off this? And just in case you need me to further drive the point home, this is simulating a 1.5 times UVXY back to the launch of VIX futures in 2004. And that's not a typo, it's gone from 641 million to $11. This last one is just purely for the laughs, but do you remember TVIX? It was a 2 times leveraged long volatility ETP that launched in November 2010 and was finally delisted just recently in July 2020. Using simulated values back to 2004, a 2 times long volatility ETP like TVIX went from $17 trillion to $112. That, in a nutshell, is why long volatility ETPs are generally viewed as only very short-term hedging vehicles because they do behave like constantly decaying insurance products. So just based on pure pragmatism, I believe that people should just get that long volatility trade out of their head and get on the right side of those charts. They clearly go down, so that's where we should put our focus. Now, of course, I'm not suggesting that people just haphazardly start shorting volatility. That can actually be even more dangerous than going long. At least when you're long volatility, you can only lose the capital that you put up. But if you short volatility and if you do it incorrectly, you can end up owing more than you have. You can owe the bank money. You can lose everything and more. So clearly the focus here should be on safe, consistent, realistic rates of return and just growing our capital slowly on that short volatility trade. But this is the general point of that first video, is don't fight those charts. The odds that you're going to be able to successfully thread that needle and make some money buying the VXX or buying UVXY is actually very, very low. So if you want to see how I personally navigate these volatility markets, you can head on over to my website, claim your free trial, and see if the VTS community is right for your investing goals. See you next time in part 2 of this series. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.